Good morning and welcome to the Cooperative Credit Unions Association complimentary webinar on understanding your risk appetite. Our speaker today is Ancin Cooley. He is the founder and principal of Synergy Credit Union Consulting, which provides a suite of risk management services to financial institutions, including loan reviews, information technology audits, internal audits, director's exams, and regulatory compliance reviews. Ancin gained deep first-hand knowledge of financial institutions while serving as an examiner at the Office of Comptroller of the Currency. During his tenure at the OCC, he performed safety and soundness examinations at institutions ranging from $100 million to $8 billion in assets. He is a well-sought-after expert contributor to a host of financial publications. He was recently featured in Forbes magazine and The Independent Banker. He holds a master's degree in accounting and financial management from Keller Graduate School and received a Bachelor of Science in Business from Morehouse College. Please join me in welcoming Ancin Cooley. Ancin?
Thank you. I appreciate you, Bill. Thank you for having me. Thank you for providing me an opportunity to provide your members with this complimentary webinar on understanding your risk appetite. What we're going to do today, our overall goal is to learn the skills and concepts required to understand your credit union's risk appetite. Before we get started, just going to share you just a little bit about myself. As you mentioned, my name is Ancin Cooley. I'm the principal of Synergy Credit Union Consulting. I started my career as a regulator. From there, I went to work for a regional accounting firm. And now I am the principal and owner of Synergy Credit Union Consulting, where we provide strategic planning, training for supervisory committees as well as boards. And one of the things that we do for boards and credit unions is that we help them develop risk appetite statements. And so some of the concepts that you're going to learn today is some of the things that allow your credit union to understand its risk appetite, what it is, and how you can use it to drive growth and revenue for your credit union. So just to kind of use as an example, every car has both a gas and a brake inside of it, okay? Every car has a gas and brake, and if you didn't have one or the other, the car wouldn't be functional. So if you had too much gas and not have any brake, you wouldn't be able to stop. But if you had a brake but didn't have any gas, you wouldn't be able to go any further. So one of the things that you have to understand is that both risk and growth and risk and production go hand in hand, just like the gas and the brake goes hand in hand. And in the same way, some of us like to drive slowly, and in the same way, some of us like to drive fast. It all depends on our risk tolerances and our risk appetite. So when we talk about risk appetite, or just risk in general, we're going to briefly just kind of talk about how do you create a risk-focused culture that allows you to drive fast? How do you ensure that your brake is strong enough to handle the growth that you're planning for your credit union? So let's start by asking ourselves, what are all our risks involved in credit unions? You have capital risk, interest rate risk, reputation risk, talent risk, credit risk. These are all risks that you want to make sure that your credit union has covered in its, that's what we call your risk universe. But next, and what we're going to be talking about for the remaining slides, is you have to ask yourself, how much risk are you willing to take? What risks are you willing to take? And then after that, you ask yourself, how are we overseeing those risks by understanding your governance and your policy structure? And then next thing you want to understand is, how are you capturing the information needed to manage risk? And so to kind of give you an example, some credit unions, when they onboard a new loan application, they only get the loan number, the borrower's name, and perhaps some additional information about the actual loan, where it be perhaps where the property, if it's a house, where it's located. However, other credit unions do things like they get the appraisal information about a particular property. They'll input the borrower's debt to income and input the borrower's credit score. And what that allows them to do is, at a high level, extract that information and get some interesting portfolio insights. For example, I have one client because they input their credit scores into their onboarding process, they're able to say over 60% of our used car borrowers have credit scores over 650. So when the regulators come in and say, hey, you have a concentration in used car lending, they're able to rebut and say, yes, we recognize that, but the characteristics of our borrowers makes us feel comfortable, and they have the data to support that. Next, you want to talk about your control environment. That's when we're talking about your internal audit and your enterprise risk management processes. How well are you managing those risks? And next, what risks are they large or are they small? Understanding what we call the materiality of the risks that you're dealing with. And then your responses to those risks. When you get an internal audit report or when your regulator has a comment in your report, how are you responding to those risks that are identified? Okay? Are you responding to them in an effective manner where maybe you're mitigating those risks? Maybe you're sharing those risks. For example, one example of one way that you can share a risk is that perhaps one of your member comes in with a large hotel loan or a large opportunity that perhaps that's too risky, but from a size standpoint for your individual credit union. And so you go to the credit union next door and say, would you like to do a loan participation with us, so that they're able to share in some of that risk and you're able to stay involved in that particular transaction. And then lastly, what else can go wrong, whereby you do some type of stress testing that allows you to understand how your balance sheet will perform under stress conditions. And all of these things combined together allows you to understand your credit union's risk culture. So let's make this a little bit more fun. So those of you that are listening, I want you to go into your mind's eye and ask yourself, are you the type of person that stops to get gas at a half a tank? Are you the type of person that stops to get gas at a quarter of a tank? Or are you like me, where you stop to get gas when the light comes on? Now, each one of you has a different appetite for that type of risk. Some people don't like waiting till the last minute before they get gas. But that depends on our individual appetites for risk. But let me introduce another concept. In addition to our own risk appetites, we all have different risk tolerances. Okay? Risk tolerances. And so to just kind of further this particular analogy, although I may be the type of person that likes to wait till the gas light comes on, my tolerance for risk changes when I'm 75 miles out from the nearest gas station. Okay? In the same way, here's another analogy. I might have the appetite to eat everything on a particular buffet because I'm really greedy, right? But my stomach can't tolerate it. Likewise, your management team might have an appetite to do subprime used cars for borrowers or members with credit scores under 600, but your capital base can't tolerate it. Okay? But your capital base can't tolerate it. So you want to make sure you understand both your risk appetite and your risk tolerances. And in the industry that we're in, particularly in credit unions, capital tends to define your tolerances for risk. Here's another cool example. I wish we were live so I could see your show of hands, but let me ask you this. Would you fight Mike Tyson for 2 rounds for $10 million? Would you step into the ring with him? Okay. What if I tied one hand behind his back and gave you $5 million? Would you be down for that kind of challenge? Or is that outside of your risk appetite? And when we do this live, I have people ask me, well, can I run around all the time? And I say, yeah, you can definitely run around all the time. But then you also have some individuals that under no circumstances would they ever get into the ring with Mike Tyson whether or not it was $10 million or $100 million. And they have a particular appetite for risk. Likewise, certain individuals on your board and management team, they all have different risk appetites. But until you sit down as a group, define it and discuss it, you can have certain groups or certain individuals, individual risk appetites driving your entire credit unions by their individual risk appetite and not by consensus. Okay? Here's another question. Would you swim across a swimming pool with a crocodile floating inside if I gave you $2 million? Now, let me ask you this, okay? You can ask me anything about it. You know, is the crocodile dead? You know, how big is the crocodile? How big is the pool? When's the last time the crocodile has been fed? Or even, is the crocodile even real? So as you can see in our example picture here, it's not even a real crocodile. And those of you that balked at this opportunity without asking any questions would have missed out on that $2 million because the crocodile that I was mentioning isn't even real. Likewise, so many of our board members or management team members have implicit biases against certain loan types that the moment it walks in, they treat it just like that crocodile without asking deeper questions that allow them to understand the risk profile of the opportunity being presented to them. For example, you can bring them a member business loan. Well, you may have lost or had a charge-off on a member business loan 5 to 6 years ago. And for some individuals, once they take a loss or a charge-off on a particular loan type, it leaves them with a lasting feeling. Well, that particular loan where you took that charge-off may have had some characteristics that raised its profile, its risk profile. However, if I was to bring you an MBL loan that had a loan-to-value of 20% and a debt service coverage ratio of 3 times, but if you don't ever get to the question of, well, what are the risk characteristics of it? And as soon as I say I have an NBL loan opportunity, you miss out on an opportunity for your credit union to have interest earnings just because you have a bias based on something that happened 5 to 6 years ago. So you want to make sure you understand your risk environment. You want to make sure you're always getting the right information so that you can make an informed decision about the risks that you want to take for your credit union, not one predicated on what's perhaps have happened in the past or your implicit biases. So what is risk appetite? As you look at this example here, I've gone tandem skydiving once, and I got some of you that would never do that because it's outside of your risk appetite, right? But it's in mind. So your risk appetite affects everything that you do. Actually, for that matter, I would recommend, and this is Ancin saying this, I would recommend that it would be difficult for you to ever have a strategic plan that whereby you do not outline your credit union's risk appetite first. Because your risk appetite affects everything you do. It affects your strategy, your budget, your credit origination. And when we talk, let me unpack credit origination. What does that mean? Whether or not you're going to do new cars or used cars and what the characteristics of those loans are going to be. Whether or not you do 1 to 4 family mortgages and the size of those mortgages. Whether or not you're going to lend in a particular geographic area. It affects everything that you do. It also affects what the new products and services that you're going to offer. Some credit unions don't offer credit cards because it's outside of the risk appetite, whereas some credit unions do because it's within their appetite for risk. And so you want to make sure that you are defining your appetite for risk as a group and not letting any one individual's biases drive your credit union's opportunities for growth. This is another one that's interesting. Your risk appetite should affect your compensation. Okay, what do I mean by that? Well, if you want your management team, and this is, I guess this comment would be more geared toward a director. If you want your management team, your CEO, your CFO, your lenders to really push forward and really drive loan growth, they have to be compensated for that. So I am an advocate for individuals to be bonused and they're having their performance measured and being compensated when they exceed their goals. One example I like to use is that you can have an individual loan officer, tenured, doing well, making $65,000 a year, okay? And you say for that $65,000 a year, you ask them annually to bring in, I don't know, $500,000 worth of loans per year. That might say, for example, say if that was their goal, okay? But that individual might have $4 million worth of loans that they can actually do if they were to really try harder. But if they're not going to be compensated for it, and all they have to do is bring in 500 and they're going to get their 65, they're just going to stay in place. Okay? And so if you want to really grow, I am an advocate of providing the compensation structure that allows individuals to have windfalls when they push past the normal and really work hard. Your risk appetite should also affect your capital allocation and the capital levels that you choose to maintain at your credit union. So let's just set this as a base for some of you. In order to be a well-capitalized credit union, you have to have a capital level above 7%, okay? 7%. Once you fall below 7%, you're no longer well capitalized, and there's some regulatory effects that come with that. And moreover, your regulators are going to visit you a little bit more often. You're going to have some more uncomfortable conversations with your examiner in charge or EIC, okay? And so you want to make sure that you're constantly monitoring that level. That level should affect and mirror your risk tolerances. And so if you're the kind of credit union that likes to provide services and loan opportunities to I guess what we would call the underserved who may have weaker credit scores, you have to have the capital necessary, that capital cushion available in the event that those loans charge off, okay? Because loans with higher debt-to-income ratios, loans with higher loan-to-values, and borrowers with lower credit scores have what we call a higher probability of default. And then some people, they get real fancy and they call it PD, okay? And so that probability of default is measured by certain factors. If a person has a higher debt load, then the probability of them running and getting strained is higher. If a person has a lower credit score, as evidenced by their ability and their past payment history, then they have a higher probability of default. And so if your borrowing base has a higher probability of default, it would behoove you to have a higher capital cushion. You don't want to operate close to that 7%. You want to build up a cushion. So that you have to make different decisions in terms of dividends and other things that you do that could take away from that capital cushion that you may have that allows you to continue serving your community, okay? Also, you want to make sure that your risk appetite should manage your portfolio limits in terms of what loans that your loan concentration types, as well as the concentration types in your investment portfolio. And so your risk appetite, I guess what this slide is essentially trying to articulate is that your risk appetite is the common thread through everything that you do at your financial institution. And you should start the beginning of the year by reevaluating it in context with your capital ratios, in context with your individual risk appetites, and then consolidate that into a risk appetite statement for your overall credit union and your different business units. So this is kind of break from some of that heavy stuff. Give you another analogy, just kind of to talk to you about risk appetite. I like to run marathons and triathlons, okay? And my mama said, Ancin, if you're going to continue running these marathons and triathlons, son, I need you to get a stress test. So I said, I responded back to her. I said, Mama, I ain't going to get no stress test. I'm too young for that. I don't need all that. She said, son, just do that for me. I said, all right. So I went and got it. They hooked those electrodes up to me, and they ran all the blood tests. And this was about 3 or 4 years ago. And they said, come to find out, I had high blood pressure and high cholesterol. Okay, and the reason why is because I was going to Five Guys Burgers and Fries 3 times a week, and at the time when I was going to Five Guys Fries, they didn't have milkshakes, and so I would walk across the street to Baskin Robbins and get a milkshake to eat with my Five Guys Burgers and Fries. All right, and what I didn't realize was that at that point in time, what I was putting on my physical balance sheet, although there weren't any signs of it affecting me at the moment, but if I continued along that path, my appetite would lead to risk of heart failure and other things. Likewise, some of your credit unions, what you're putting on your actual balance sheet in terms of the loan choices that you're making, although you're getting a lot of fees on them, strong interest income on them, but down the line, you may see some charge-offs that may affect the health of your credit union. So you want to make sure that you understand your appetite. So what did I do? Well, I changed my diet. Do I still eat Five Guys Burgers and Fries? Yes. Not as often. Do I still eat red meat? Yes. But when I eat red meat, I make sure that I'm compensated properly, meaning that I eat a good piece of red meat. I make sure that it's healthy, and I make sure I get it from a good restaurant. And in the same way, if you're going to take the risk on a lower credit score, you have to make sure that you price it accordingly. Some of you have mistakenly may have this concept that as a credit union, you're for the members, and whether or not the person has an 800 credit score or a 550, they deserve the opportunity to have the same interest rate as everyone else, and that is flat out wrong. Individuals with 550s have a higher, as we mentioned, probability of default. So if you charge 3% for a person with a 550, you're going to lose all the income because some of those are going to charge off. So you have to have a sliding scale by where you have a risk-based pricing structure, so that individuals with higher credit scores get lower interest rates, and individuals with lower credit scores have higher interest rates. And so you want to make sure that you have that in place, and that is distributed throughout your branch structure, so that various branch managers and different individuals understand that they just can't override your pricing structure because they know the person. Okay? This is a part of you earning. So let's just pause for a second. Let's just quick review. What happens when we get interest income? The interest income hits our bottom line. That at the end of the year, that net income, after you take out for your allowance, guess what that does? That supplements your capital base, which provides you with the cushion necessary to do what? Continue lending. And so you're actually, by not charging the proper interest rate for lower credit scores, you're impeding your ability to continue serving your community, because you're throwing good money after bad by not properly compensating and not getting compensated for the risks that you're taking. Okay? And so your risk appetite should drive all of your strategic decisions toward loan growth, Your risk appetite is like your car. Your risk management processes are like your lights that guide you, let you know when risks are coming down the pipeline. Your risk tolerances are like your guideposts, and the board is on the road, and your policy parameters allow you to understand and distribute your risk appetite throughout the organization. Okay? That's why every year you should review your risk appetite, and right after you review your risk appetite, make sure that you update your policies and procedures to ensure that your policies and procedures reflect your risk appetite. So let me give you an example. 2 years ago, you may have had an appetite to have, I would say, let's say, for example, between a concentration of 35% for used cars, okay? And that's what's in your policy. The total portfolio makeup for your loan portfolio won't exceed 35% for your total, as a percentage of your total loan portfolio. Okay? But you may realize that, you know what, you have a strong niche, meaning you may have a good industry that you're attached to. There may be some good things happening in your community with new jobs and things of that nature, and you're looking at the charge-off history of your used car program, and you're saying to yourself, hey, we should lean into this a little bit more. Maybe we should reevaluate our risk tolerances, and maybe we should take it from 35% to 42% or 45%. Because that's the thing that's generating you the most interest revenue, and you've shown that you've had success. So let me make this clear. I'm a consultant. I do internal audit. We do MBL loans, strategic planning, things of that nature. I was an examiner, but I'm not one of these individuals that tries to communicate to credit unions that they have to be extremely risk adverse. There's a difference between being risk adverse and not understanding the risk environment in which you operate. Complete difference. I'm not an advocate of being risk adverse. I'm an advocate of understanding the risks and managing it and mitigating them properly. Okay? So you want to ensure that your policies and the parameters that you set up reflect what? Your risk appetite and your risk tolerances. I mean, I go to some credit unions, I ask them for their loan policy. You gotta knock off the cobwebs off the thing, when you get it, because they just don't revisit it enough. Okay, and let me speak to some of these loan officers or some of the CEOs that just don't like stronger policies. Okay, these policies for your examiners are all your examiners have as terms of like a reflection of what your processes are. And oftentimes see these policies as an impediment to growth. And I guess as I'm thinking through this, that's the wrong way to approach it. These things keep you in check. Your risk tolerances and your policies are like that best friend that you have that's looking over your shoulder saying, I know you want to go down that road, but let's stay within these lines so to make sure that we're able to continue operating in a safe and sound manner. So let's play a quick game here. All right? I want you to look at the characteristics of this loan here. So, would you approve a car loan with a 580 credit score, a 30% debt to income, where the borrower hasn't missed their payment in 8 years? Now, when I typically ask this question at conferences, I get a whole bunch of hands. 580 credit score, debt to income, borrower hasn't missed a payment in 7 years. Most people will take it. Some people won't. Those are the type of things that you need to discuss amongst yourselves. Now, would I originate that loan? Yeah, I originate that loan all day long. sometimes the credit score isn't a true reflection of the borrower's willingness to pay you. Okay? It's a person-by-person decision. However, some larger credit unions have to operate systemically, whereby they have to have strong policies in place that are credit score driven, and I understand that as well. But that might be an opportunity for a smaller credit union to step into that sweet spot and provide that opportunity, because they're going to go deeper into the credit report to understand it. For example, you look at the 580, but when you open up the credit, you say, they got a 580, but they ain't missed a house payment in 10 years, and they haven't missed a car payment in 8 years. So where's the issue? Oh, they don't pay Sally Mae on time. And now for some of you say, well, that's still problematic, but one of the things that is relevant too is, are they going to pay you? Okay? And so that allows you to provide that opportunity. Now, would you give that person the same interest rate that you would give somebody that has a 750? No. But there's still an opportunity there for you to serve your community and for you to make a decent spread in the interest rate if you have a risk-based pricing model in place. All right, so here's a different one. Would you approve a car loan with a 700 credit score and a 55% debt-to-income ratio? Now, this one's a little bit different. Person has a 700 credit score, which means that up until this point, they haven't had a lot of missteps. They haven't had a lot of snafus, if you will, right? But apparently, they are increasing their debt load. This one's a little bit trickier, at least for me, in my opinion, because although a person has had payment history, one of their leading indicators, as in their debt-to-income ratio, is communicating to us that they're leveraging themselves up. And so the misstep could be pending or could be coming. Now, if you would choose to do this particular loan, I would price it accordingly and really take a look at that debt-to-income ratio. And so let me ask you a question. And you can email me or we can talk. I'll provide my email at the end of this webinar. But one of the things I guess somebody might ask is it depends on their salary, right? 55% debt-to-income ratio is a lot different with somebody that makes annually $40,000 than different from a person that might make $250,000 annually, right? So those are some different characteristics, some of the things that you have to really consider when you're looking at these different loan opportunities. And the last one, would you approve a member business loan to purchase a commercial building with a 30% loan to value and a 2.5 debt service coverage ratio? Now this should be quick, easy, quick. Yes, you should take this loan all day, every day, and twice on Tuesday. Why? And so let me not assume that everyone on the line has done a commercial real estate deal. What that loan to value is communicating at 30% is that it has 70% of equity in that property left over in the event that something happens. Okay? If you had to take it back. All right? You could sell it quickly and make a profit. And what that 2.5 debt service coverage ratio communicates is that their payment, their cash flow from that commercial building is able to cover the debt payment 2.5 times over. So that's a strong loan. But some of you have biases towards certain types. And soon as I say MBL loan, you're like, oh, we don't do that, or commercial buildings, that's not for us, or what have you. Some of you don't even have a member business loan product. But there's some members who would love to do business with you if you just offered the service to them. And they have these opportunities. This one, for example, say if this was a $250,000 loan, that one $250,000 loan could be a substantial windfall for your income this year. You can sit around and do a whole bunch of $1,000 loans this summer, or back to school loans, or 500, and I don't begrudge you for that. That is a benchmark product for us to be able to provide services to our members in our communities. But that strong $250,000 loan would throw off enough income that would allow you to what? Get the capital cushion that will allow you to do more for individuals in your community. So you would just want to take a step back and not be rash, not just immediately have a knee-jerk reaction to loans based on a particular type. So let's understand that this dynamic risk environment. So management's, how does this work? How does this process? Because I just don't like talking about theory. We're moving to how do we execute this process at our credit union? What are the next steps, Ancin? How do we get this implemented next week or by the end of the year? Okay. So one of the first things you want to do is management sets its objectives. What is our direction? And they do that with board oversight. Okay. So management with board review and concurrence articulates a risk appetite that is acceptable in pursuit of the objectives. For example, if you say, you know, we want to grow, and I see this a lot, and I hear this a lot. We're going to grow loans by 7%. Yay! Everybody claps their hands. But in what areas? What loan types? And what are going to be the characteristics of those loans? Okay? You have to outline that. And then next, management sets tolerances around risk acceptable at the organizational level or functional unit level in the measuring of those objectives. Okay? Let me bring it home for y'all a little bit. So imagine if your credit union is a restaurant, okay? And you recognize that your customers has an appetite for fish, okay? Now, you can do one or two things. You can tell your fishermen or your loan officers to go out and catch fish. But wouldn't it be more effective to tell them what kind of fish that you want to cook? Do you want bass? Do you want catfish? Do you want perch? Do you want trout? Do you want striper? You know? All too often, credit unions just tell their loan officers, let's grow loans, but they don't tell them what fish to go catch. They don't tell them what their risk appetite is. Okay? And so how does that map? You just use another example. If you would imagine that we have A-type loans, B-type loans, C-type loans, D-type loans, and E-type loans. A being the best loans, credit scores, I don't know, over 800, and E being our worst, I guess you would say, our higher risk loans, maybe credit scores between 550 to 600. What you have to be able to do at a systemic level is know what percentage of your portfolio is A, B, C, and D type, and what percentage of your portfolio is E type, okay? So that going into the new year, you can say, you know what? We don't have an appetite for D and E loans based on our risk tolerances, based on our capital levels. We only have an appetite for A and B loans, okay? Conversely, if you're looking at your loan growth and you're stagnant, nobody's walking in, you can't get a loan approved because your risk appetite is too low, you're missing out on opportunities. You might be in a very competitive market where everybody's going after those individuals with credit scores over 700. And so you may be saying your policy might say we only want A and B type, but if you're only going for A and B type, you're not going to do any growth. So you may have to say we may have to do some B- loans, some C plus loans, some C minus loans, so that you can find your sweet spot to grow and get the interest spread so that you can be compensated for the risk-based pricing mechanism that you should have in place. So what does a risk appetite statement look like in real life? Okay, so let me give you an example. The statement goes, we measure and track operational losses and incidents across the organization to identify root causes, mitigate risks, and ensure that losses are within acceptable levels. What's the metrics? We don't want our operational loss or revenues should be less than 1% for all business units. And so what we've done is we've taken a risk appetite statement and we've consolidated into something specific. Now, again, somebody's alarm going on. Oh, I don't want to be restricted. I don't want to be measured by that. Well, we all should be measured. We all should have some light post so that we can know how well we're doing. Now, should it mean something punitive should happen if you go above that 1%? Not necessarily, but it should be an opportunity to have a conversation about where we are. Okay? The next risk appetite statement here is related to talent management, and I know this is out of context for this particular discussion, but I will say, as I'm doing strategic planning and helping with budgets and just generally working with credit unions around the country, one of the biggest risks is talent risk. If you don't have the right people in place, you won't be able to execute your strategic planning. You won't be able to have the talent to push forward, okay? And so the reason why they have a risk appetite statement related to talent management, because this credit union recognizes how important that is. So in this one, it says, we strive to establish and maintain a talented workforce, especially through professional development and retention of high employees. And so it says we should have a retention rate of high potential employees will be at least 90%. That means, hey, when you have your annual meeting, annual evaluations with them, and the person gets a rating of high potential, you want to retain at least 90% of those individuals. Why? Because you need them to grow. You need them to take on new products and help other people grow. You need them to take on projects like developing your new CECL model. But if your best people are jumping ship, you won't be able to push forward with any of your strategic plans and growth goals. And so these are this is an example of what risk appetites look like when you're actually getting into them and actually defining them for your credit union. So this is another concept. We were talking about risk capacity. Okay? Risk capacity is similar to risk tolerance, but it's your capacity, how much capital do you have? And so in this example, it's like if you have an extra $1 million in capital, meaning maybe the difference between being well capitalized and falling below well capitalized is $1 million, what would you go into? Would you do a member business loan? Would you do an SBA loan? And why? What are some of the characteristics? Well, we know about SBA loans. We know they're guaranteed, right? If underwritten properly. All right? So you want to make sure that you understand your risk capacity. So in this particular example, we have a credit union with a net worth of reserves of $35 million. And in this example, they have total assets of $338 million, roughly. Okay, that gives us a net worth ratio of 10.34%. So they have an $11 million cushion before they'd fall below 7%. $11 million. So let's go back one. What if we took, and this is the type of things you need to do in your boardrooms when you're trying to discuss new measures and new initiatives. Just don't discuss it conceptually. Break it down. Somebody's saying to you, we don't want to do member business loans. It's too risky. And you say, well, guess what? Look at our situation. We have an $11 million cushion. What if we took $1 million of that and we dipped our toe into member business lending or SBA loans? Just $1 million. If we had to charge off that entire $1 million, would we not still be well capitalized? Yes. And given the collateral that you would have for a commercial real estate loan or the guarantee that you have in an SBA loan situation, you would even take $1 million loss. But all too often, we don't get into the specifics. We don't get into the numbers and break it down and really show individuals our thought processes as to why we should leap forward and take certain types of risk. Here's another example, though. Different credit union, similar, same asset size, but they have a smaller net worth. They only have $25 million. So they have a net worth ratio of 7.44. They only have a $1.6 million cushion before they fall below well capitalized. Well, that's a different situation. Their appetite or risk tolerance may be different. So they may not want to go forward with a more riskier endeavor, a more riskier loan types until they're able to supplement their capital in a way whereby they have the cushion necessary to sustain losses. So my spidey senses are tingling here. I can hear somebody saying, we're too small. It's too risky. We don't have the skill set. We've successfully implemented risk appetite statements and risk appetite processes at credit unions as small as $22 million. But we also put them in place in credit unions as large as $10 to $12 billion. This isn't a situation where you can say, this isn't for us or we don't have time. You can't afford not to outline and define your risk appetites. As we move forward in terms of execution, this is just an example, and just want to let you know, at the end of this webinar, I'm going to provide you with a slide that has my email address. Email me, and I will send you an example toolkit that will have an example risk appetite statement, an example risk appetite survey so that you can provide it to your board members, and some other items that allow you to push forward as a credit union with this process so that you can execute. At Synergy Credit Union Consulting, we are about strategic execution. Okay? So in this survey, we asked, what risk appetite do you believe that decision makers throughout the organization currently exhibit in the way that they set direction, make decisions, and monitor performance? Are they open? Are they flexible? Are they cautious? Are they minimalist? Or are they adverse? And these are the type of questions that you should ask in your strategic planning process so that you can discuss it and everyone be on the same page. And so in closing, just want to, I know this is in this particular webinar recording, feel free if you have any questions to email me at acooley@syncuc.com. Again, the email address is acooley@syncuc.com. Email me, and I will reply, provide you with a wonderful takeaway toolkit that will allow you to move forward with executing and developing your risk appetite and risk tolerance statements. Also, if you need any help or would like any consulting or around that matter, feel free to email me as well. I'd like to thank you all for having me today for this discussion in this webinar today, Understanding Your Risk Appetite. Enjoy the rest of your day and have a great year. Thank you so much.
Ancin, thank you very much. And I just want to say to the credit union folks out there listening, if you have any trouble with his email address or contact information, please reach out to us here at the association and we will get you in touch with Ancin. So again, thank you very much. Remember, Ancin is going to is one of our featured speakers at our annual meeting and convention this year from October 10th to October, a pre-conference session on director best practices, as well as a breakout session on understanding audit reports. So that concludes our webinar today. I'd like to thank everyone for joining us, and have a nice day.